Hi, Tamal. Thanks for coming on the show again.
Sure.
Now, in your column this week about rupee, you highlight two things. One is the psychological 80 rupee to a dollar barrier. And the second, that rupee is still stronger compared to its REER, or real effective exchange rate calculations. So is RBI right in managing the value of rupee?
One question, your first one is about the obsession with this round figure 80 years. Even I also wonder what is it? I mean, why not 79 or why not 81 or 82 for that matter? In fact, Dr. Jalan, RBI governor during the East Asian crisis time, he did not believe in any round figure. He used to hit the traders, those who were in the market and creating volatility. He used to hit them hard at odd levels. So that had been the RBI policy at that point of time. So one of the reasons could be, the option contracts are written in that round figure. If it is not in round figure, then it leads to more volatility. So that could be the reason. I really don't know. I don't see any logic behind the obsession. Why not 79? Why not 81? What's the big deal about it? Other part is this, yes, on the real effective exchange rate RE, that's the 36 country basket, trade basket, rupee is overvalued. But does that mean that RBI should not do anything? No, definitely not. Because if you see, RBI never says that it has any number in mind. What RBI is concerned about the volatility in the market. So RBI steps in, whether I mean selling dollar in the spot, and sometime earlier it was also working through the forward markets in the past, but essentially to iron out the volatility. And traditionally, rupee, if you look historically, has always been on the higher side based on RER. It's not something for the first time what we see.
You quote a Reuters report about India having the capacity to spend $100 billion more to keep the rupee stable. But doesn't a stronger rupee run the risk of India losing out on its export competitiveness?
No, again, it's not. This Reuters report quotes an unnamed source, so we really don't know who is the source. But if you hear, if you must have heard the Reserve Bank of India governor in recent past at a Bank of Baroda function, he spoke about we need to sell dollar because what's the use of umbrella unless you use it during the rain. But the point I'm making, again repeating, Reserve Bank of India is not spending dollar or want to spend dollar to strengthen rupee. All it wants to do is iron out the volatility, which is not good for that. So I don't think it wants to strengthen the rupee. It again, the very fast depreciation, which is not required, because then what happens is this: exporters rush for cover, importers don't bring their money back, and all those kind of things happen. So it all wants a orderly way of moving the rupee, whether it's going beyond 80 also. That's not the. I mean, internally they probably have some figure in mind, but that's not official. But all along, historically, Reserve Bank of India stance is we don't have any particular figure in mind. All we need is to iron out the volatility.
You mentioned in your column about other measures other than selling dollars and what India has resorted to in the past. Now, what can be those measures in the current scenario?
No, historically, if you have seen that we have gone and raised money overseas with SBI as a proxy for the sovereign, and then 2013 during the taper tantrum, we raised FCNRB, which giving a lot of incentives to the banks. And now, of course, now also Reserve Bank of India has taken quite a few measures. For instance, CRR, SLR, etc., being waived for the timing on FCNRB. The cap on ECBs have been on the automatic group has been raised. Also, the internationalization or globalization of rupee. You can put invoice on rupee and do trade in rupee. These are the things in works. I think it will take time. RBI will use its resources, which is foreign exchange reserves, judiciously to again stabilize the rupee and and ensure an orderly movement.
Mhm.
Not any. I would not like to believe that any more uh, measure is required to raise money overseas.
One of the interesting points that I found from your column was your discussion about the India's forex profile, right, which is a closely guarded secret, as you point out. Now, how is India's forex profile is different from other nations, and how is it a problem for India if rupee depreciates more?
What I meant about the profile is actually the composition, meaning how much is in dollar and how much is in other currencies, reserve currencies and all. So which we do not know. Reserve Bank of India does not tell us. And one of the reasons why foreign exchange reserve is being depleted is, of course, rupee's weakness, but also the weakness of other currencies, be it euro, be it pound sterling or Japanese yen, vis-a-vis dollar. So when you have those in your basket and when those currencies are also depreciating, then your foreign exchange reserves will deplete. It's not the rupee alone. So that's a composition of it. And profile, if you see that, unlike many other countries, we are a current account deficit country. So it's what the so-called foreign exchange assets. What are they? They are nothing but debt. And if you look at the RBI numbers, it gives out how much is the short-term debt and with residual maturity of 1 year and how much is exactly 1 year debt and so on and so forth. So that way, of course, we are very different from others. We are the fourth largest foreign exchange reserves we have globally, above Russia. But that gives us, well, we can be very gung ho about it, but it's not the reserves that we own. It's primarily debt. That's the difference between India and many other countries.
Let me take you a bit off topic from this week's column. Now, bank profits are zooming again, whatever results have been out. What is the reason behind this, especially as treasury income was supposed to decline this quarter?
Yes, yes, treasury income has taken a hit because of the sudden rise in interest rate. RBI had gone for two hikes, 40 and 50, 90 basis point, and that impacted the 10-year bond yield. What is compensating it and actually adding more to the profit is A, credit growth, so the interest income is going up, and B, the depletion in bad assets. In fact, the cost of bad assets, the provision cost or the so-called credit cost, it's coming down. It's pretty low if you look at for the most of the banks in the first quarter. So when your bad assets are not growing, when you don't need to provide for, so the provision was eating away banks' profits in the past many quarters, which stopped actually sometime last year. So once your credit is growing, your interest income is growing, and your bad assets are in control, you are not increasing the bad assets, and you don't need to provide for. You have already sufficient provision coverage ratio. Then that's a good time for banks. And yes, there's a minor hiccup as far as treasury income is concerned. They have been hit, but I mean, it's more than compensated by the interest income and the very low.
Thank you. Thanks again for coming on the show. We hope to see you again next week. Thank you.
Thanks.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.